Back to Hamilton. Here's Ron. Good afternoon.
Hey, how you doing?
Good.
I'm talking about Tourmaline, and I know it's down to 26. It was high as $50, pretty close to it. Should I hang on to it? Is it going to go up? Should I buy it when it's a little bit lower now, or can you give me, help me out? Thanks.
Sure. So, Ron, I'll come at this from a couple directions. The first thing that I would say, at Barometer, we are focused on finding strong companies within groups that have a tailwind in sectors that people care about right now. And clearly, energy has been a difficult space for the last 18 months, and it's one that continues to be difficult. Within the group, Tourmaline is a high-growth company, but having said that, has a lot of gas exposure and so on, and the price of gas is very, very weak. And so I would be careful of this for a couple of reasons. One, because in disclosure, in some of the funds that we run, we're actually short the energy sector. The idea of buying something that's trading at new lows at this time of year is tricky. We're about to head into a period that people do a lot of tax loss selling, November and December, and these companies are going to be right in the gun sights of investors taking losses against gains in other parts of their portfolio. So I just would be very careful. Now, we are not value investors who try and buy things that we think the market is mispricing. We basically believe that ultimately the market gets things right. And so they have had a tougher time fundamentally, and it's in the wrong group. I would avoid the stock.
Thank you, Ron. A tweet now on Facebook from at B2 Invest. The company's reporting earnings Wednesday. What's your opinion? Is it a good time to buy it? It seems like it's going great guns.
So when in our sector work, in the work that we do, we try to identify areas of the market that are seeing new buyers come to the fore. And so the way we track that is we take a universe of stocks, say 100 stocks, and we measure the percentage of those stocks that are in upward price trends. And if the percentage of stocks doing well is expanding, it means more and more money is finding its way to that group. Well, clearly the internet group is one that is performing extremely well. And you can get a good look at that if you look at the ETF FDN, which is an internet-related ETF, and is probably the strongest ETF on the market, and it includes companies like Facebook and Amazon. Facebook as a company is doing a great job of monetizing all of that traffic that goes through every day. And they are increasingly finding ways to generate revenue mobily through their main site. And so you've got a strong stock, a winner, in a group that people care about. And frankly, the US market, we think, is the most attractive market of the global markets. You've got 3 check marks. And 80% of return comes from get to the right market and get to the sector that people care about. 20% is specific to individual securities. And this is behaving extremely well, which is doing what we think it should do, given what we know. So I'd be a buyer of the stock, and we do own the stock.
Just a quick question here. You've got FDN in your fund, which is the First Trust Dow Jones, which we just saw. You've also got the Power Shares NASDAQ Internet ETF. So is there overlap on those two? Why do you have
There is some overlap. The FDN has more exposure to internet retail, and PNQI is more broad-based internet exposure. They both are behaving extremely well, but the consumer side, which is of course led by Amazon and things like some of the internet travel companies, is really got a tailwind.
Okay, so you're filling in some holes with the other ETF. I think we're going to show them together here. Both of them doing splendidly, as we see there over the last year. Let's take a call from a 5-year here as well, just for the heck of it.
If I can just make a point on this. One of the things that I would say is we do a lot of fundamental work on the companies we invest in, but we really care how they're behaving market-wise, because the market tells us a lot. When the S&P 500 retested the August low in September, which is around 1870 in the S&P, one of the things you should ask yourself is which sectors held up much better in the second decline? And you'll notice on that chart, they never came close to retouching the lows from August. And then the next question should be, what is it that was able to go on and make a new high before the market has? And so very clearly, this internet group was the last group to break down. It's the first group to make new highs. Technically very, very sound. And you shouldn't be afraid in a strong market to own the strongest stocks. They're the ones with a bunch of happy shareholders, and And fundamentally, these companies look very attractive.
And that goes to your point at the top of the show about the leaders leading the way out of the correction. And as we go to break here, I believe we're going to take a look at those two internet-based ETFs along with the S&P. We're going to look at a 3-month to exemplify what you're talking about, the rebound. S&P is in blue, so there are those two internet-based ETFs surging higher and leading the way. There you go. Okay, past picks from David Burrows right after this break.